Thank you, everyone, for being here. It's Cameron Malik here, and I'm going to be joined by my trading partner, Mark Austin, through the presentation. So this presentation, we're going to be giving you an introduction to index trading. So many of you may know about fundamental analysis and technical analysis. However, there is a third element to trading that we're going to teach you through this presentation today. Now, identifying high probability trades can be a lot easier than you think, and it may take a lot less time. And today also, we're going to be teaching you a trade that is delivered just under 10% averagely over the last 4 years. It's only going to take you 10 minutes to do a month. So do make sure you've got a pen and paper handy to take down the parameters for this trade. Also, Mark's going to be giving you an overview of what's in store for the markets in 2021. So thank you for the introduction. A little bit further, Mark and I have a combined trading experience of the last 30 years, and we've really been helping clients just like you make money from the markets for over a decade. And as Alex said, Mark is in the FTSE market, which is the London Stock Exchange, and I focus on the Australian, the US, and the German market. So essentially, Mark and I are index trading specialists, and we're a little bit unique in the fact that we do publicly trade our own fund, and over the last 5 years, we are up over 200% on our trading. So now I'm going to hand over to Mark, who's going to give you a little bit more information on index trading.
Okay, thanks for that, and welcome, guys. Great to be here. And Alex, thanks again for inviting us to a unique seminar. Usually it's in person, but it's obviously with what's going on, this is the first time we've had to do a seminar like this. So hopefully you guys enjoy what we're going to teach you, and at the end, if you've got any questions, you'll be able to fill a form in, and we can come back and answer those questions for you. Okay, so let's get cracking on. So index trading, well, what is an index, first of all? Well, it's a collection of stocks bought and sold as pairs. So if we take the example of there's 100 companies within that index or that package, and some of those companies you'll know, BHP Billiton. There's some really big names within those companies. So when you buy an index, you are straight away diversifying your risk. You're not just buying one company, you're buying the best companies. So in your market, the S&P have in there, and that also has the best companies within that. In America, you have the Dow Jones, you have the S&P again, and you have the Nasdaq with companies, etc. So some big names within these index markets. The good thing as well with these indexes is you can trade the markets in both directions. So just because we had the coronavirus and the economy went down and markets sold off, that doesn't mean we can't make money. That's the beauty of trading, is that we are in a recession-proof business. It means whatever is happening in the world, we can still make. What is good means we can make money. What is bad means we can also make money, which is very unique. A lot of businesses are not like that, and that's specifically why we do like trading. Okay, so why index trading? Well, we have, Cameron as well, we've tried Forex, we've tried individual stock trading, we've tried commodities. Haven't really tried trading Bitcoin too much. We will actually touch on that subject at the end. But we really fell in love with the index markets, really because they are actually very predictable. So they do perform certain functions over and over again, which once you know them, you can plan your life around and take advantage of them. We can also trade at a set time. So we specialize in the golden 30 minutes. So when those index markets open, because unlike Forex markets, they do close and open at a set time each day. So we know that currently at 7 p.m. Sydney time or 8 a.m. UK time, we can trade the FTSE and the DAX. That's when they open. So we're just checking everything's okay with this visual. Just 2 seconds, guys. Okay, fine. So yeah, so we traded in the golden 30 minutes. So we actually log into a live trading room there with our clients. They see our trading screen and they alongside us. And that's really where our best trades are delivered. And as I said, we're usually done within 20, 30 minutes. So that's nice. We can plan our life around it. We're not sat at the screens all day long. Okay, also, most of the time we are fully liquid, which means that because our trades are done quite quickly, we don't need to be holding trades overnight. So they, in the early days, I used to trade a lot of hold a lot of trades overnight, and actually I actually like getting into the market, taking the cream and getting out again. We're not after the cheese these days. Okay, so that's a little insight into why we like index trading. Again, we're going to teach you some trades as this presentation evolves. So also make sure you have a pen and paper next to you, because we will be giving you some rules for some trades which you can take away from today and you can implement as early as tomorrow. So there's three traditional ways, well, actually mainly two traditional ways to trading, and I'm sure you'll know these via LTG Gold Rock. The first is technical, so chart patterns, bull flags, support resistance areas. These are all very common ways to trade. And there's also fundamental. So fundamental is looking at the economy, looking at interest rates, government intervention, stimulus. That's another pillar which people look at. But one thing a lot of people are not aware of is market function. So a little question to you guys now is, what is the true function of the market? What are the markets there for? Just type into the answer box now. What do you think is the true function of the market? I'm seeing a few answers come through. The answer is the markets are there to maximize trade. They're there to match up buyers and sellers. So that is the true essence of the market. So what we did here at Magnetic Trading is, because of that, we want to wrap around a trading strategy that is linked to how markets operate in the first place. And that is called market function. And it also takes advantage of inefficiencies. So what we want to do is we want to identify when the market's inefficient. So when there is an area in the market where no buyers and sellers have been matched up, we want to take advantage of that, because we know the market in most cases is going to come back to those areas and match up buyers and sellers. How do we know that? We know that because that's why markets exist in the first place. And that's why we're able to get a very high success rate within our trading here at Magnetic Trading, because we're linking a strategy that's linked to how the markets operate in the first place. Now, the market function element as well is also, these are events that are happening in the background behind the markets that are driving the markets up and down. Again, I'm not talking about fundamental analysis here, I'm not talking about technical analysis. These are things that are going on in the background that we know about, that is going to influence the price to go up and down. That is very, very key knowledge to know. It does give you that edge. Now, if you can then link fundamental, technical, and market function, then you have a real edge in the market, and you will outperform most retail traders out there. let's have a little example of this. So we call this a champagne trade. So every Wednesday, if we take the FTSE 100 as an example, there is a dividend declared on the index. Sometimes it's a very small dividend, sometimes it's a larger dividend. But within that index, there are, of course, those 100 companies. Those 100 companies have shareholders. And as a reward for being a shareholder, a lot of these companies declare dividends. So if a dividend is declared on an individual company, then it must be allocated to the index as well. So what we'll find is that if there's a big dividend on a number of stocks for a certain week, you'll find investors buy up these stocks to get the dividend. Okay, the dividend's then paid out, happy days, but then the next day, traders will influence the market to move up to get out of those stocks at a price that they paid for them. So they bought the stock, they've got paid the dividend, then the next day they're looking to get out of the stock at a price that they bought it or slightly higher. We call this the champagne trade. So around lunchtime, after a big dividend, the dividend needs to be really over 9 points. And again, you can check with your broker when there is a big dividend on the FTSE. But if it's over 9, we see this happen time and time again. In fact, it happened just 2 days ago, guys. I'm going to show you a trade that it's the last trade we did this week for our clients, but I'll show you a live example of this in a second. We had a 9.44 dividend this week, and we saw the market rally. We saw the investors buy up the market to get this dividend, but then the next day we saw a rally in the morning into the lunchtime session, which then sold off. Nothing technical. This is just pure function. What is happening behind the scenes of the market to move the market up? This gives you a real edge in the market. So this was our trade report. Again, this was issued before the market even opened. We give this to our clients. It pops up on their phone. But you can see the trade for the day. We were looking to sell from 63.68. We were looking for 100 points of profit, and we had a stop around 100 points as well. We knew this information before the market opened because, again, within the index market, there are certain occurrences that happen which repeat time and time again, which if you know, you can take full advantage of. So this was the message: look to sell at 63.68. This was on the 12th, so just a couple of days ago, 2 days ago, we were looking to trade this. This is what happened. This is 7 p.m. Sydney time is when the market opens. So you can see 7 p.m. on your screen. You can see we rallied up to 63.68, and then we sell the market. And then we had 100 points that came off that move. This is a 5-minute chart, but if you look on a longer time period, you'll see that 100 points came off this move. This is the champagne trade. Took advantage just 2 days ago, all linked to market function. What's another example of market function? The extreme gap. So unlike Forex markets, the index markets have gaps. So a gap is created from the closing and opening price each day, or the highest price or lowest price. For the extreme gap, we're looking at the highest traded price during the day or the lowest traded price. So in this example on the 2nd of November, so again, not very long ago, we can see that on the 2nd of November, the highest price on the FTSE, you'll see this, if you just look across on the 2nd, you'll see FTSE, and then the highest price was 5665. So just make a note on your notepad now. Write down 5665. This was the highest traded price on 2nd November. Okay, so every day I make a record of this because sometimes it can be very, very important. Because if the market opens above the market high the next day, we call that an extreme gap. So it's a level where the market's opening, where no traders facilitated. Remember, what are the markets there to do? They're there to facilitate trade. They're there to match up buyers and sellers. So if there's an area in the market where the market hasn't facilitated market trade, it will often come back down to those levels to match up those buyers and sellers. So we make a note of this one. Now, on this particular day, we actually had the elections. So we had the historic Biden and Trump war going on, and just before the European market opens, the polls were actually pretty in line. It was 50-50. So each candidate had a 50% chance of winning. There was no real clear direction of who's going to win. So nothing had really happened. But what I had noted was that the market was positive, and it moved up quite a bit because the markets they'd sold off before the election, and I viewed that once the election was over, the markets were going to rally. So we were looking to buy anyway, but it had moved up a little bit too high for us to buy. But we had recorded that there was this unfilled extreme gap down at 5665. So you'll see again, this is on our trade report. This is before the market opened. We can see that we have an unfilled gap down at 5665. I like this area for buys. We're going to have our stop below 5,400, and we're going to target 6,000 for year end. Of course, it's gone a lot higher than 6,000 because we've now had the vaccine. But on this day, the market opens. Just before the market opened, the market came down, hit 5656, and then it was off. There was no reason for this move coming down. The presidential elections, the polls were pretty neutral. No news had come out that someone had won. So the move down here was classic market function. It was moving down to fill this area of no trade where no buyers and sellers had been matched up. It gave us an optimal level to buy the FTSE. Very, very low risk as well. It was hit this pinpoint and then it was off. And it really hasn't returned, guys. We've actually seen about a 14% return on our money since this low was printed. So these market function movements are very, very, very powerful in the index space. Okay, so what I'm going to do now is I'm going to hand you over to Cameron now, and he's going to teach you this DAX first of the month trade. And remember, this is also a market function trade. This is an event that's happening behind the scenes. It's a systematic trade. So again, get that pen and paper ready. Make a note of this trade so you can trade it on the first trading day of December.
Okay, thanks very much. So this really does follow on from what Mark's been talking about with market function, and it really piggybacks on the back of institutes pumping money into the market on the first trading day of the month. Doesn't matter if the market longer term or mid-term is trading up or down, so it's either negative or positive. There still is an effect of money being introduced into the market on the first trading day of the month. And remember, guys, this has returned just under 10% over the last 4 years. So here are the rules for trading this trade. It's very, very easy and simple to understand. We're going to enter into the German market at 10 p.m. German time. So 10 p.m. German time. If you want to convert that, you just go online, and there's many online converters that will convert the time from where you are to German time. So just go online and search that. And we're going to trade this on the day before the first trading day of the month. So if the first trading day of the month is a Tuesday, we're going to buy on the evening of the Monday session, so 10 p.m. German time on the Monday. So if the first trading day of the month was a Monday, we'd be buying on the Friday session. So it's always the day before. Also, we can look to trade this if there is a holiday before the first trading day of the month. We can enter from what we call the Globex Open, which is at 12, so midnight German time. That's only when there's a holiday. Again, really, really easy. You just go online and search the DAX, the holidays for the DAX, and you can find out all the holidays for the year. And we do nothing. We just enter the trade with a 40-point stop. So you use 40-point stop. Our risk is typically 1 to 2% of your account, and you hold the trade until noon German time on the first trading day of the month. So you simply enter on the evening before, hold the trade, don't do anything. There's no analysis to be done. You don't have to figure out highs or lows or where resistance is or anything like that. You simply come out at a set time on the first trading day of the month. We've done all the hard work for you. This time is the optimum time over the last 15 years to come out of the market. So there's no hard limit on the target at all. And this is one trade that you can get a massive multiplier of your actual initial risk. So we'll give you an example here. This is an example that we entered the market here. You can see the entry point right here when the market is actually just closing for the futures. That's the time, 10 p.m., just before 10 p.m. It's when the market closes. And we entered at 11,545. And of course, our stop loss is 40 points. And you'll see that it's slightly over 40 points because we're accounting for the spread from the broker. So always account for your spread, whatever broker you use, and you can trade this on any broker as long as they have the DAX 30 instrument to trade. We can see the market gapped up here. This is the market opening back up, and then all the way through the overnight session, and then coming into the open here, market just continually moves up, and we exited at noon German time with 120 points of profit. So that was a 2.8 times return. And as I said before, this is a trade that you can really get a massive multiplier on your trade, and no analysis at all to be done with the trade. Simply place it, leave it, and come off at the set time. So just looking at the results here, 2016, just a bit of a flat year, 1%. 2017, 16%. 2018, 12%. And last year, 8.6% on the trade. So now I'm going to hand you over to Mark, who's going to give you an outlook for the markets for 2021.
Okay, thanks for that, Cameron. So hopefully you jotted down those rules for the DAX, and there'll be an opportunity to get some further information at the end of this presentation as well. There'll be a form which you can ask some questions. Alrighty, so for 2021, well, certainly 2020 has been an eventful year, that's for sure, of all this coronavirus. There is, of course, the vaccine, which is going to be coming out from Pfizer, 90% success rate. So that will probably get approved probably just before the end of the year, and then they'll be rolling that out in 2021. But again, all of this news has been priced into the markets already. But what we are seeing, though, is particularly for the FTSE, we're seeing undervalued stocks. So we're seeing sector rotation movements within the FTSE. We're seeing cash that's coming out of tech stocks, and it's going into undervalued sectors like retail, energy, leisure, banks, travel. And the FTSE is very plentiful of these stocks. So that's why we're seeing a very big rally come into the FTSE 100, because it has been pretty much undervalued for the whole of the coronavirus 2020 events compared to other markets. So we look at the DAX, we look at the US markets, particularly FTSE has been hit pretty hard. So I'm really expecting a continued recovery on the FTSE. It's trading around 63.50 at the moment. I'm expecting to see 6,700 early next year. So I think we'll start seeing, well, we will get some pullbacks, but that's a target that I'm looking for into early 2021. And then I think we'll see another big sell-off in that area. In terms of the US markets, the valuations are very high. We just need to be aware of that. And there has been a lot of stimulus. So the risk in the American markets is inflation. If inflation takes off, we could see rising bond yields, which is negative for the stock market. That said, I do think we'll still see a nice rally and some higher prices come into the US markets over the coming weeks. I think there'll be a good Christmas rally, but of course, because the valuations are still very high in the American markets, there is still going to be these yearly big sell-offs, and that's what you want to be taking advantage of. You want to be waiting for the big pullback, which will always come most years, and if you're wanting to get into the US markets, wait for that, because as I said, we are at historical high valuations for the American stock markets. And DAX as well, almost at all-time highs as well. Again, expecting a Christmas rally to come in there, breaking all-time highs as well. But again, 2021 will be waiting for big pullbacks in that market as well. Again, the reason the DAX hasn't underperformed like the FTSE is because it doesn't have big sectors of energy and leisure within that index. And again, people are still expecting the Nasdaq to fall off in 2021. I don't think it will, but I think there will be some pullbacks in the Nasdaq, which is, that's the index where you've got your Amazon and your Apple. But I still think that's a very favorable space, but valuation is extremely high within that index. So if you're going to get into the Nasdaq, wait for big sell-offs in 2021 and then get involved with that space. We are going to host a part 2 of market function, market efficiency. We're going to be teaching you some more trades within that. So there is going to be a form which is posted into the chat box in a moment, which means you can sign up for free. That's a free webinar. We're also going to give you our phone app, which you can download again for free, which we will send certain trades that we're taking on our own fund. It's not going to cost you anything. And we'll also provide some free insights into the index markets. So that's our own magnetic trading app that you can download absolutely for free from the App Store. It's also for the Android. So we'll post that link in now into the chat box. All you need to do is put your name and email in, and you can take advantage of that. Of course, we will also answer any questions that you have. I'm sure that many of you have questions from today's webinar. So once we've got a little bit more time for this part 2, we can really answer those questions for you. Right, let us try and put this into the chat box now, this link. Just bear with us for a second. Okay, that is now posted in, guys. So you should see that. coming up in your chat box, LTG Gold Rock magnetic link. So all you need to do is click on that link, and then we can send you access for these free gifts that we are giving you.